Did you know that a staggering 56% of Ontarians believe the rental market is unbalanced? It's a pressing issue that's affecting families, students, and seniors across the province. Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. The Ontario Real Estate Association, commonly known as OREA, is raising significant concerns about the current state of Ontario's rental market. According to a recent report titled A Fair Rental Market for a Stronger Ontario, OREA warns that without urgent reforms, the rental system could continue to fail both tenants and landlords. As highlighted by the REM editorial team, the report presents 20 action-ready recommendations aimed at creating a more balanced and inclusive rental system. Among the key proposals, OREA suggests overhauling the Residential Tenancies Act of 2006 to better reflect today's market and improve affordability. They also recommend restoring in-person hearings at the Landlord and Tenant Board while keeping a virtual option available. These changes aim to address the growing backlogs and inefficiencies currently plaguing the system. OREA is also looking to expand mediation services, drawing inspiration from British Columbia's tenancy model to further reduce backlogs. Another significant recommendation is to mandate equal treatment under the Condominium Act of 1998, supporting diverse family structures in the rental market. Moreover, offering tax incentives to responsible small landlords who create new rental units is seen as a vital step toward expanding the housing supply. In a statement from OREA President Kathy Poland, she emphasizes the need for a fair and efficient rental market that keeps the door to homeownership open for everyone. Ontario needs a rental market that is fair, efficient, and keeps the door to homeownership open to everyone who wants to achieve that dream, she said. That means we need more accessible and affordable supply across the housing spectrum so families of every size can find a great place to thrive. The urgency of these reforms is underscored by a July 2025 survey conducted by Abacus Data, which found that 82% of Ontarians are concerned about high rental costs, while 62% worry about limited availability and 49% about poor unit conditions. Only 32% express satisfaction with dispute resolution at the Landlord and Tenant Board. OREA's CEO, Luigi Favaro, highlighted the importance of these reforms, stating, "As both a landlord and father of renters, I know a fair, balanced rental market is key to housing affordability across the spectrum, and the policy solutions Ontario realtors put forward today will do just that." OREA stresses that implementing these reforms would not only strengthen tenant protections, but also support responsible landlords and ultimately stabilize Ontario's housing market. These measures aim to create a more equitable and sustainable rental landscape, ensuring that all Ontarians have access to safe and affordable housing options. In a recent development that could have significant implications for the Windsor area, the former Konica Minolta office building has been sold for $2.7 million. This sale marks an exciting shift as the property is set to be transformed into 300 new housing units. The 20.64-acre site at 500 Day Hill Road was purchased by subsidiaries of Condyne Capital Partners and Mark Greenberg Real Estate, according to the Windsor Town Clerk's office records from August 4th. The history of this property is quite interesting. It was last sold in 1994 for $12.1 million to Diamond Lease USA Incorporated and later transferred to Konica Minolta in 2011. Now, with its sale to the new developers, we are looking at a promising redevelopment plan that includes not only residential units, but also commercial space. Mark Greenberg, the principal of Mark Greenberg Real Estate, has shared that the existing 99,720 square foot office building will be converted into residential use, with 3 additional multifamily buildings planned for the site. The conceptual design plan, dated July 14, 2025, outlines 4 multifamily residential buildings totaling approximately 385,000 square feet. This plan also includes 3 commercial buildings, adding up to about 18,400 square feet, with a substantial parking provision of 514 spaces for residential use and 144 for commercial purposes. The residential units will primarily consist of one and two bedroom apartments, with around 10% being studio units. What makes this project particularly unique is the suitability of the existing office building for residential conversion, which isn't always the case with former office spaces. Mark Greenberg noted the significant demand for residential units in the area, highlighting the tremendous need for apartments. This sentiment seems to be echoed by the local government, as the Town Planning and Zoning Commission recently approved a zoning text amendment. This amendment allows for the adaptive reuse of vacant and underutilized industrial facilities for multifamily housing, granted a special use permit is obtained. This approval follows a broader initiative to revitalize the Day Hill Road area, with discussions of establishing a Day Hill Corridor Design Development District. While a formal application for this project has yet to be submitted, the optimism surrounding it is palpable. The developers have engaged in several meetings with Windsor officials, and it seems the town is supportive of the plan. This is not the first real estate activity in the area involving these developers. Earlier this year, Mark Greenberg Real Estate sold land along Old Poquanock and Day Hill Roads to Condyne Capital Partners, who subsequently sold it to New York-based PNK Group. This transaction is paving the way for new warehouse developments approved by the local planning commission. It's worth noting that the Konica Minolta office building, constructed in 1982 and last appraised at $3.75 million, has a rich history in the Windsor area. Although Konica Minolta's operations in Windsor ceased in 2019, the company has maintained a presence on Day Hill Road. However, they plan to vacate the premises by the end of this year, making way for this exciting new residential and commercial development. In a recent report by Colliers Canada, the investment conditions for Canadian commercial real estate are seen as increasingly favorable compared to those in the United States. The report, titled Why Invest in Canada 2025, highlights that past perceptions of Canada being more difficult or expensive for foreign investors are outdated. Adam Jacobs, head of research at Colliers Canada, noted that the global instability often leads investors to the U.S., but now the U.S. itself is the source of some of that chaos, making Canada appear more stable and safe for global investors seeking diversification in North America. The report also emphasizes Canada's strong demographic fundamentals, with population growth rates significantly outpacing those of the United States in recent years. Although Canada is experiencing a temporary correction in immigration numbers for 2025, it's expected to regain its demographic advantage by 2027. Canada benefits from lower interest rates, with 10-year bond yields below 3.5%, creating a more favorable borrowing environment compared to the U.S. This differential in borrowing costs is significant, especially in a market where leverage is common. Canadian central bank target rates are forecasted to remain below U.S. levels, contributing to a more stable investment climate. Despite global interest rate hikes aimed at controlling inflation, Canada's commercial real estate market has shown resilience, with the MSCI Commercial Property Price Index posting mostly positive figures. Canada's market performance surpasses all G7 nations, as well as Singapore, Hong Kong, and Nordic countries, making it one of the top-performing global markets. Interestingly, the report points out a renewed interest in office spaces in Canada. While industrial sectors have been dominant in recent years, the office market is seeing a resurgence due to limited new developments and a push for more in-office work. Canadian cities like Vancouver, Toronto, and Montreal have lower vacancy rates compared to major U.S. cities, highlighting the vibrancy of Canada's downtown cores. The U.S. is experiencing overbuilding in office and retail sectors, whereas Canada maintains a more measured pace of development. This restraint is seen as advantageous for long-term investments, reducing competition and risk. However, despite these positive indicators, foreign investment in Canadian commercial real estate has fallen to just 3% this year, down from higher levels in previous years. Jacobs believes this is a temporary dip and expects foreign investment to rebound as global market conditions stabilize. In conclusion, Canada's commercial real estate market remains a robust option for investors, offering stability and strong returns amidst global volatility. The fundamentals are solid. And as the market continues to adapt and grow, opportunities abound for those looking to invest in this promising landscape. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.